Hey, what is up everyone, it's David here. In this video, let's talk about whether BigTinCan is worth your time, and then I'll wrap up the video with a portfolio update and also the new stock I'm adding into my portfolio. If you're new here, the number on the top left hand side of my thumbnails represents how much my portfolio is worth as of recording that video. And the reason why the number is always going up is mainly because I make regular contributions to my portfolio. Now the whole point of doing portfolio updates is to take you on a journey with me and show you all my ups and downs as I strive towards financial independence. It's inevitable that I'm going to be wrong in the future. The question is how wrong? And my goal is not trying to be right. It's just trying to be less wrong over time and learn from my mistakes. At the end of the day, I'm just some random shaved head Asian dude on the internet. So I'm not a professional and you should never use my videos as financial advice. But if you do learn something new, consider gently tapping the like button. So without further ado, let's go! I've broken my coverage on BigTinCan into three main parts. 1. What does the company do and how does it make money? 2. Does the financials and numbers show that the company is moving in the right direction? 3. The management team. I won't go into BigTinCan's valuations since I found majority of their competitors are private. But Kenjo did do a valuation comparing BigTinCan to some of our Australian tech companies. So highly recommend you to go check out his video on BigTinCan right after you finish watching this one. As of recording this video, BigTinCan is trading at $1.27 with a 478 million market capitalization. Now, BigTinCan is a sales enablement software as a service company. It basically means that a company will pay them a monthly fee to use their software. The whole point of sales enablement is to give your salespeople the right training and the right collateral just in time so that your potential customers can move towards a buying decision more efficiently. For example, if you're selling financial services, you want your salespeople to have a pitch deck that's tailored to the potential customer, compliant to regulations, and have the most updated results so that they can make deals faster. On top of that, you might also want to do just-in-time training so your salespeople understand how the potential customer's industry operates before they head into a meeting. Now, BigTinCan is one of 5 solutions who can provide sales enablement software to businesses. The companies leading the way in sales enablement is Seismic and also HighSpot. What you need to know with Seismic is their latest investment round of $100 million in 2018 is led by T. Rowe Price and Lightspeed Venture Partners. The fact that T. Rowe Price led the investment round signals IPO ambition, and co-founder Doug Winter have confirmed that in a TechCrunch article. In today's low interest rate environment and a lack of asset class choices, it's likely that going public will give Seismic access to a huge amount of capital. And compounding that with a co-founder-led team consists of mostly ex-senior Dell EMC employees, this is a formidable foe. And HighSpot, led by mostly ex-senior Microsoft employees, are funded by Salesforce Ventures, means that they can also leverage Salesforce Enterprise Cloud expertise. Again, another formidable foe in the battlefield. And if we take a look at the top of page bid, businesses are willing to pay 3 to 5 times more to show up under other search terms compared to BigTinCan. As a matter of fact, for Showpad, people are willing to pay almost 10 times more just to show up as the top result on Showpad. No businesses are willing to pay that much per click if it's not commercially viable. Now, the spike you see in monthly searches is mainly caused by the pandemic, as the work from home trend would have pushed organizations to accelerate their sales enablement programs. And as of their latest investor presentation, BigTinCan's customers are relatively diversified across multiple industries. With no exposure to travel, you can rest easy that a chunk of BigTinCan's revenue isn't going to suddenly disappear. And fun fact, BigTinCan has been part of Apple's mobility partnership program since 2015. And that means that they get a chance to work with Apple's design team directly before a new iOS update is released. And when the new iOS update are released, the app is compliant and they can leverage the best features the new update can offer. This is definitely an advantage from a mobile experience perspective, and Showpad is the only other competitor that's also part of the mobility program. Okay, let's take a look at the numbers to see whether the company is moving towards the right direction. Personally speaking, the 3 most important metrics in a SaaS company is annualized recurring revenue, retention, and LTV to CAC. There's actually one more that's missing that they don't provide, and I'll talk more about this in just a second. And with financials, we're really just trying to see whether the company is growing their recurring revenue and retaining their customers. Now, ARR stands for Annualized Recurring Revenue, and that basically means the monthly recurring revenue times by 12. And since FY18, they have grown their ARR by 52% compounded annually, which is great to see. With retention, this is basically the percentage of customers that have stayed a customer after 12 months. You want this percentage to be as high as it possibly can be. And since FY18, BigTinCan have improved their retention rate by 2% every single year. It's going to get harder and harder to improve their retention rate from here. I'll be pretty excited to see what the new retention rate is in the next financial year. LTV to CAC is just a ratio to gauge how much of a customer's lifetime value is a company willing to pay just to acquire one customer. I'll give you an example in just a second. But according to the previous Chief Marketing Officer of HubSpot, a good LTV to CAC ratio for a growing company is anywhere between 3 to 5. BigTinCan right now have a LTV to CAC ratio of 3.9, which basically just means that they are spending approximately 25.6% of a customer's lifetime value to acquire one customer. Now, how you get 25.6 is just 1 divided by 3.9 and you get 25.6%. Now, if we compare that to FY18, they were spending close to 38.4% of a customer's lifetime value just to acquire one customer. So the fact that they are spending less and less of a customer's lifetime value to acquire a single customer, that's a great sign to see. Now, a critical piece of information that's missing from these investor presentations is the payback period. That is, how long does it take to recoup your customer acquisition costs? It doesn't matter how good your LTV to CAC ratio is. If it takes you 5 years to recover your customer acquisition costs, it's very expensive to grow the company. Not to mention, the faster you can recoup that customer acquisition cost, the faster you can redeploy that capital for growth. Now, if we take a look at their latest balance sheet, there is more than enough current assets to cover both current liabilities and non-current liabilities. As a matter of fact, $71 million of the $79 million are cash, and that's compounded by the fact that they did do a capital raise in May 2020. This will enable them to go hunting in this environment for more acquisitions to grow faster. Compounding that with no debt, they will have no problem in the short term to weather the storm. The question is whether they can spend that money to grow efficiently. In terms of management team, the key character is David King, the founder CEO of BigTinCan. Before BigTinCan, David founded Veritel Wireless, which within 3 short years grew to be one of the largest providers of wireless internet in Australia. And then that company was sold to Big Air Australia for $4.5 million. My biggest concern with BigTinCan's management team is whether they can recruit talent on a global scale. Ultimately, they are going up against Seismic and Highspot with incredible investors and also very deep talent pools. But so far, BigTinCan's numbers are showing they can compete on a global scale. But the question is, what kind of company will BigTinCan ultimately become? And depending on what you think they'll become, you can somewhat determine whether they'll have a chance in winning. As it stands, I don't have an answer to that question, and I'm very curious about what you think. So talk to me in the comment section below. Now, before I do a portfolio update, if you want access to my video scripts, my research, and also be part of my fortnightly Q&A, not to mention some additional content pieces, consider supporting this channel via Patreon. Now, I'll leave a link in the description box below for anyone who's interested, but nevertheless, it already means the world that you're watching this video. So thank you very much, and let's jump into a portfolio update. So with my CMC market portfolio side of things, it's worth approximately 60,000 Australian dollars. What I want to remind you of is that the foundation of this portfolio is largely built on either ETFs or listed investment companies. Now, I have a big chunk of this portfolio invested in Wax, which is a listed investment company. I have another chunk of my portfolio invested in VTS, which is an ETF that tracks the entire US market. And I have another very big chunk of this portfolio invested in Argo Investments, which is another Australian listed investment company. Only after I have built my foundation, then I feel really comfortable picking individual stocks. But the thing I want to remind you of is that I am a long-term investor, and I never unload a big sum of money into a single position at a given time. I always build my positions after I've done some strong due diligence on that company. And as you can see, I initiated my position in Novanix with $1,000, $1,000 in Talga, and $1,000 in Volpara. And as my investment thesis becomes stronger, more confident, I will eventually add more and more money into those positions. I'm okay with losing all of my money in that because I know I have a strong foundation that's already being built with ETFs and listed investment companies. I don't plan to sell any of my positions anytime soon. A lot of my individual positions, I do plan to hold on to them greater than 5 years. I will only sell if I am consolidating a position into a better opportunity or the competitive advantage of a company suddenly disappeared and there's no point of me holding them anymore, then I'll possibly sell them. As it stands, I'm planning to add a little bit more into VTS, but I will bring you over to my US stake portfolio and show you the new stock I will be buying. So with my stake portfolio, it's currently worth about 12,532 plus 1,297. So about 13,800, which is approximately, say, close to 19,000 Australian dollars. So I'm currently sitting on $1,300 worth of cash, and because Tesla is more than 10% of my portfolio currently, I don't plan to add more into that unless the share price becomes so attractive. Then I'm going to shuffle my portfolio a little bit just so that I can buy a little bit more Tesla. But more importantly, more than half of the cash will be added to a new position that I am buying, and that stock is Disney. Now, let me explain to you why I am adding Disney into my portfolio. Now, the reason why I'm initiating a Disney position is mainly because they were absolutely destroyed during the pandemic, since a big portion of their revenue did come from parks, experiences, and products. And as you can see, compared to the previous year, that number have reduced significantly. I do believe that park experiences and studio entertainment will recover after the pandemic, but what's really impressive is that Disney Plus have grown to be 60.5 million paid subscribers as of August 2020. And of course, ESPN Plus, because of the pandemic and the work from home trend, the growth have been very, very substantial. Now, one of the biggest moat with Disney is their content library. Marvel alone have so many characters that they can build movies from. And these movies will ultimately act as an entry point into Disney Plus as they spin off a lot of these characters into its own individual TV series. And the first one we're about to see is WandaVision. I'm pretty excited for that. So let me know if you're a Marvel fan as well, because I am such a Marvel nerd. And as part of their 21st Century Fox acquisition, they actually own a stake in DraftKings as well. So as ESPN Plus grows, that will grow hand in hand with their stake in DraftKings as well. Now, the one last thing I want to say with my US portfolio is that Dropbox and GoPro are not part of my portfolio, and they are free stocks that's given to me when you try Stake for yourself. Now, I am not sponsored by Stake. I just use Stake because it's so much easier and affordable to invest in US stocks compared to other platforms. On that note, if you wouldn't mind a GoPro, Dropbox, or Nike when you try Stake for yourself, I'll leave a link in the description box below. So thank you so much for watching this video all the way to the end. If you have learned something new, consider gently smashing that like button right there, subscribe to my channel, and click onto the bell so that when I release future videos, you'll be the first one to know. And if you have any topic suggestions that you'd like me to cover in the future, let me know in the comment section below as well. As usual, Otto will always do the honors, and see you very, very soon.